Good morning and welcome to T-Hub Capital, the Investors Lounge, the podcast where we explore financial market dynamics, emerging trends, and the insights that shape successful investments. Each week, we'll delve into the strategies and analyses that drive our investment decisions. You'll get an insider's perspective on the factors influencing markets and the potential winners and losers of tomorrow. Subscribe to the podcast to stay ahead of the curve and make informed investment choices. Enjoy listening.
European market dynamics, geopolitical headwinds and macroeconomic divergence. The European financial landscape experienced noticeable downward pressure this past week, as reflected by the Pan-European Stocks Europe 600 index, which closed with a 0.85% decline in local currency terms. Despite broadly robust quarterly earnings growth across European corporations, market sentiment was demonstrably constrained by escalating geopolitical tensions. Specifically, reports of stalling peace talks between the United States and Iran have catalyzed concerns regarding potential spikes in energy prices. From an analytical standpoint, such energy shocks risk reigniting inflationary pressures, which could compel central banks to maintain or elevate interest rates, directly impacting the corporate cost of capital and valuation models. This risk aversion manifested across major regional indices. Germany's DAX contracted by 1.59%. France's CAC 40 experienced a pronounced 1.97% decline. Italy's FTSE MIB fell by 0.35%. And the UK's FTSE 100 slipped by 0.37%. Examining the real economy, macroeconomic indicators present a mixed regional picture. Eurozone industrial production for March 2026 registered a modest month-over-month growth of 0.2%, marginally missing the market consensus of 0.3%. This aggregate figure masks underlying sector and geographic divergences. While intermediate and capital goods drove the expansion, energy and non-durable consumer goods contracted. Furthermore, at the sovereign level, Germany experienced a decline in industrial output, standing in contrast to the production increases recorded in France, Italy, and Spain during the same period. Labor market dynamics and investor sentiment further highlight regional disparities. In France, first quarter macroeconomic data revealed that the national unemployment rate climbed to 8.1%, exceeding expectations and reaching its highest threshold since early 2021. However, a granular look at the data shows that youth unemployment, ages 15 to 24, exhibited a marginal improvement, decreasing to 21.1% from the previous 21.5%. Conversely, forward-looking indicators in Germany showed relative improvement. The May reading of the ZEW indicator of economic sentiment recovered to -10.2 from April's -17.2, substantially outperforming the forecasted -19.8. Despite this relative beat, the absolute negative value underscores continued investor caution, structurally driven by the aforementioned weakness in German industrial production, volatile energy markets, and sustained core inflation above the 2% target. In the United Kingdom, both consumer fundamentals and political stability are currently facing significant headwinds. According to data provided by the British Retail Consortium, UK retail sales contracted sharply by 3.0% year-over-year in April, representing a stark deviation from the 12-month average growth rate of 1.8%. This consumer contraction is compounding the negative market sentiment generated by domestic political uncertainty. Prime Minister Keir Starmer is currently navigating intense leadership pressure following several ministerial resignations, alongside market speculation regarding a potential leadership challenge from Andy Burnham. For financial markets, this dual burden of declining consumer activity and political instability is actively pressuring both UK equities and the valuation of sterling. Now our insight into alternative markets. The strategic appeal of the Italian M&A market, sector dynamics and foreign investment trends. Over the last few years, The Italian mergers and acquisitions market has consolidated its position as one of the most dynamic and strategically interesting arenas in Europe, and the data for 2025 and the opening months of 2026 confirm this evolution. After the strong post-pandemic phase and the normalization observed in 2023 and 2024, Italy closed 2025 with approximately 1,460 transactions for a total value of around €74 billion, a level that testifies to a healthy market capable of sustaining a high deal flow despite geopolitical tensions, higher financing costs, and macroeconomic uncertainty. This performance is even more significant if one considers that 2025 followed a year already robust in terms of volumes and values, and that the Italian M&A pipeline at the beginning of 2026 remains rich, with several tens of billions in transactions under discussion or in advanced structuring. The picture that emerges from the most recent industry reports is that of a market that has become more selective, but no less active. The Italian M&A environment is increasingly driven by industrial logic, portfolio repositioning, and strategic consolidation, rather than by purely opportunistic or financially engineered transactions. 2025 saw a high number of mid-market deals, in line with the traditional structure of the Italian productive system, alongside some significant large-cap operations, especially in banking, infrastructure, and energy, which contributed materially to the overall value of the market. In the first months of 2026, the number of closed transactions shows a physiological slowdown compared with the most intense quarters of the previous cycle. But the quality of the assets in play and the size of the announced pipeline support a positive outlook for the remainder of the year. A structural feature of the Italian market that has not changed is the strong presence of cross-border activity. Inbound transactions, in which the target is Italian and the buyer is foreign, continue to represent a significant portion of volumes and, above all, of the value of deals. International investors, both corporate buyers and private equity funds, are attracted by a set of characteristics that are not easily replicable in other jurisdictions. A dense network of medium-sized companies with strong export orientation, specialized technological know-how, high product customization, and the reputational capital associated with a made-in-Italy brand. Acquiring an Italian business often means securing immediate access to premium product lines, niche technologies, and consolidated commercial relationships in strategic value chains. From industrial machinery to luxury goods, from food excellence to mechanical components, the mid-market remains the beating heart of this dynamic. Italian mid-caps, frequently still controlled by families or founding entrepreneurs, offer a combination of factors that is particularly attractive in the current environment. Solid fundamentals, defensible niches in international supply chains, room for managerial upgrade, and for a more structured approach to capital allocation, and significant optionality for buy and build strategies. For foreign buyers, entering Italy through the acquisition of a medium-sized platform can be the most efficient way to establish or strengthen a European presence, immediately integrating Italian know-how into global production and distribution networks and creating synergies both on the revenue and on the cost side. From a sectoral standpoint, the industrial universe continues to represent the core of Italian M&A, confirming the weight of advanced manufacturing in the country's competitive positioning. Transactions involving companies active in automation, machinery, precision engineering, industrial technology, and high-value components account for a substantial share of deal volumes, reflecting the persistent appetite of both industrial groups and sponsors for assets capable of combining export resilience, technological depth, and the possibility of incremental investments in innovation. The digital transformation of production processes and the growing relevance of data and software in industrial applications further reinforce the strategic interest for Italian targets positioned at the intersection between traditional manufacturing and enabling technologies. The consumer and luxury segment remains another pillar of the Italian M&A story. although the narrative has become more articulated than the simple search for iconic brands. Transactions in food and beverage, fashion, design and premium consumer goods are increasingly evaluated in light of the target's ability to scale internationally, defend margins, and adapt their business models to new distribution logics, including direct-to-consumer and omnichannel strategies. The global demand for Italian products with high symbolic content from wine and gastronomy to fashion and high-end accessories continues to support sustained investor interest, particularly when the brand is authentic, the positioning is clear, and there is still ample white space in key international markets. Technology, broadly defined, is assuming a progressively transversal role within Italian M&A. Alongside pure-play software, IT services and digital platforms transactions, technology is increasingly a critical dimension of deals in industrials, financial services, healthcare, and utilities. Buyers place growing emphasis on the digital maturity of targets, on the degree of integration of data and analytics into operations, and on the potential to exploit artificial intelligence and automation to improve efficiency and competitiveness. In this sense, M&A in Italy is not only about acquiring tech companies. It is about acquiring technological capabilities and embedding them into larger industrial and service platforms. Healthcare and life sciences also continue to attract capital, albeit with a more targeted and selective approach. Specialized providers, diagnostic services, biotech niches and companies offering high-value-added medical technologies are at the center of interest for both industrial players and private equity, with attention focused on scalability, regulatory robustness, and the opportunity to build integrated platforms starting from Italian centers of excellence. At the same time, energy and infrastructure, especially in the segments related to the energy transition, renewables, networks, and sustainable mobility, are increasingly central in the deal flow, driven by regulatory frameworks, public incentives, and the strategic need to reposition portfolios towards greener and more resilient assets. Financial services deserve a separate mention, given the acceleration of consolidation processes recorded between 2024 and 2025 and the prospects for 2026. The banking sector, asset and wealth management, fintech solutions, and specialized credit platforms have been at the center of several high-profile transactions and strategic combinations, contributing disproportionately to the total value of the Italian M&A market in the most recent period. This wave of consolidation responds to the need to gain scale, optimize cost bases, strengthen capital positions, and invest in digital infrastructures capable of supporting new business models, in a context where competition and regulatory requirements remain demanding. If volumes and sector dynamics confirm the vitality of the Italian market, the composition of capital flows provides additional strategic signals. Besides inbound deals, outbound Italian acquisitions have reached their highest levels in years, a sign that Italian corporates and financial investors are becoming more proactive in international expansion and portfolio diversification. This two-way movement of capital reinforces Italy's role as an M&A hub integrated into global value chains, rather than a purely passive recipient of foreign investment. The regulatory and political context, while more articulated than in the past, has not fundamentally altered the investment case for Italy. Mechanisms for screening foreign direct investment and sector-specific controls, particularly in sensitive areas such as defense, energy, telecommunications, and strategic infrastructures, require careful structuring and early engagement with the authorities, but the overall approach remains oriented towards preserving openness to international capital while protecting national interests. For sophisticated investors and advisors, this translates into a higher premium on preparation, governance, and transparency, rather than into insurmountable barriers. In macroeconomic terms, the environment at the beginning of 2026 can be described as one of cautious optimism. Expectations of more accommodating monetary conditions compared with the peak of the tightening cycle, together with signs of stabilization in inflation and gradual improvement in financing terms, are creating a more favorable backdrop for leveraged transactions and for valuations based on medium-term growth and margin assumptions. At the same time, lingering geopolitical risk, energy price volatility, and the persistence of valuation gaps between buyers and sellers continue to require discipline and creativity in deal structuring. From earnouts to vendor financing, and from minority investments with governance rights to phased integration structures. Overall, the updated data for 2025 and the early indications for 2026 confirm that the strategic appeal of the Italian M&A market is intact and, in some respects, reinforced. Italy remains a market in which acquirers, whether foreign or domestic, can access a unique combination of industrial depth, brand capital, technological competence, and entrepreneurial talent, within a framework that still offers attractive entry multiples relative to other mature European economies. The centrality of mid-caps, the resilience of industrial and consumer sectors, the growing pervasiveness of technology, and the acceleration in financial services and energy transition make Italy not only a place where many deals are done, but a place where the right deals can generate substantial and durable value creation for sophisticated investors with a long-term strategic horizon.
Thank you for listening to this episode of T-Hub Capital, the Investors Lounge podcast. I hope you found this content interesting and inspiring. If you enjoyed this episode, don't forget to subscribe to the podcast so you don't miss a single episode, and share it with your friends and colleagues who might be interested. To learn more about T-Hub Capital and our activities, visit our website, thubcapital.com. You can also follow us on our LinkedIn page. See you soon. All the best from the T-Hub Capital team.